Okay, good evening, guys. Well, tonight we're going to talk about Fibonacci, a very close study to my heart. I use Fibonacci pretty much in every chart that I use, so a very important topic tonight. Before I start, as always, need to read the risk warning. Remember that spread betting and safety trading can carry high level risk of capital. It results in losses exceeding its deposits. It might be suitable for everyone, so please ensure you fully understand the risk involved. The information and comments provided herein under no circumstances consider unauthorized solicitation to invest. Nothing herein should be construed investment advice. The information provided is believed to be accurate the date it is produced. Again, education only. Content and comments of the webinar is personal opinion of the moderator. No intro.com. The content does not constitute financial investment or tax advice. Intro.com is not liability for the content comments shown in this session. So, what is Fibonacci? Well, Fibonacci is a mathematical formula that presents itself in all aspects of nature. And again, it does, weirdly enough, happen in the financial markets. So if you think about basic proportions, that's where I like to think about Fibonacci. And I generally use Fibonacci in the retracement method. So if something goes from point A to point B very aggressively, then it has to retrace itself very much the way that Fibonacci does. The Fibonacci numbers, again, are a mathematical sequence. The Fibonacci retracement is something quite different. That is percentages based upon the actual numbers themselves. So if you want to think how Fibonacci works, then all you have to do is think your forearm is the same size as your foot. Might not believe me? You can try it right now. All you got to do is just line up your forearm with your foot, and it's the same size. Okay, that's the way these things work. That's Fibonacci in play. Fibonacci in nature. It's making sure that things are proportionally balanced, and that's how I believe Fibonacci should work. That if anything, needs to be understood from a start point to an end point, then Fibonacci for me is the way to do it. And Fibonacci, again, it works a lot of the percentage of time. So I would say that 80% of the time, a very strong, aggressive buying or selling move will retrace at least to 50%. So I'll take 80% in trading anytime. Okay, so unlike your MACD, your RSI, your Bollinger Bands, don't really give you any kind of clear cut ways to kind of get into the market. I believe Fibonacci does, because once you've posted an aggressive move, be it on 15-minute candles or an hourly candle, once you've picked the high and the low, Fibonacci set in stone that the 50% will be the key point in the market we're trying to get back to. So for me, for retracements or even the extensions where you can do the 100%, the 161 spot 8, when the markets, when you're trying to pick new highs. For me, Fibonacci generally, in some form or another, works really well in the markets. And right now, it doesn't matter if you trade Forex, commodities, or the indices. All markets right now are breaking out and moving aggressively. And for me, Fibonacci is the only way, I would say, to kind of give yourself a realistic target. Right now, levels are there to be broken. So your trends are there to be broken. Your straight lines of support and resistance are there to be broken. But Fibonacci, again, once you pick the low and the high, or if you're trying to do extensions slightly differently, but they're always there, as a real-time means to trade the intraday market. So Fibonacci, if you're using it the right way, is very important. So Fibonacci breaks itself down into a few different studies, and you can do retracements, time zones, fans, arcs, and expansion. I'll be totally honest, I don't use anything but retracements and expansions. But again, as my role as chief market strategist and my role as bringing education, I have to tell you all the different ways in which you can use Fibonacci, because it might be different for you. But in my experience, I use retracements and I use expansions. The fans, the arcs, and time zones, they're just a different way of presenting Fibonacci. They don't really work for me, but it's not to say they can't work for you. Again, it's like anything. Any technical study has to be used on the correct time frame. There's absolutely no point in doing Fibonacci retracements on a minute candle. There just isn't, okay? Unless the market's moved 300 ticks in 1 minute. Okay, it can happen, but it's very unlikely. So for me, it's all the things that I've tried to teach over the years. Go back to basics. look at your hourly charts. If you're going to do a Fibonacci, it has to be a sustained, aggressive, at least, I would say, 15-minute candle. But in more realistic terms, I would say an hourly candle. Okay, so 1, 2, 3, 4 solid buying green candles or red selling candles. Do your Fibonacci from that. Okay, unless the market's moved in one candle very, very aggressively, you have to take into a series of candles. You'll make sure you give yourself a fighting chance, a good edge. Nothing's going to retrace if the move's not finished. So picking the high and the low is the difficult part. But once you've picked the high and the low of a specific move, once you've drawn your Fibonacci retracement on there, then realistically, the next part is quite simple. So the basic Fibonacci is the theory is the mathematics behind it. Okay, so it's it's the Fibonacci numbers in a sequence that generate the Fibonacci code. But Fibonacci retracement is basically just put into percentages, which we all understand as human beings what they are. So obviously 0 is the start point, 100% is the end point. So once you've drawn the start to the finish, then really you've got the 23.6, 38.2, 50%, and 61.8. Now for me personally, I generally focus around the 50%. It sounds almost obvious, but I tell you what, if you pick an opportunity in any market that trends heavily, okay, and it goes from a high to a low aggressively, you draw your Fibonacci on, and I tell you, 8 times out of 10, it will test that 50%. Okay, this is 12 years of being in the markets. Okay, plenty of guys out there that have been in markets for 10, 20, 30, 40 years. That's fine. I can only tell you, again, and be honest, what I know has worked for me over the last decade or so. And for me, it's all about the 50%. Well, John's just pointing out that some traders use the 76.4 level also. I'll be honest, John, I've never come across that. So, yes, if they do, then that's great. I mean, I only use Fibonacci. All I try to do when I'm using any kind of technical study is to use it in its broadest sense. So, okay, I'm paying attention to 23.6. I'm paying attention to 38.2. I'm paying attention to 61.8. But I'm not that interested. I'm interested about the 50%. So I'm either buying the 50% or selling or buying into the 50%, because that's the key level for me. 38.2, 23.6, the 76.4. They're all there and thereabout. I'm interested in the 0.0, the start point. I'm interested in the 100% and the 50%. Because once the 0 and 100 are in play, then that's the Fibonacci. Okay, that's the Fibonacci retracement sequence. It has to either close below the 50% and make a new low, or close above the 50% and make a new high. Okay, it can't do anything else. And if you're using it on the right time frame, as I suggested, 15-minute or hourlies, that generally will be your 80% edge. It doesn't always do that, but it will do eventually. Okay, so doesn't mean it's like anything in trading. There's no holy grail. There's no exact way of trading. But if you keep to these principles, that if a market goes from point A to point B, 0 to 100% aggressively, then at some point it's going to have to retrace. People are going to have to take profit, either buying or selling, to 23.6, 38.2, 50%, or 61.8. And different rules go into play, because once you've hit the 50%, if you close below that, then you retrace the entire move. If you close above it, you generally make a new high or a new low. So it depends how you draw your fibs in. Well, I don't know, John. I mean, what level is stronger? It doesn't really make any difference to me. What is stronger? I mean, what's more important to me is once you've drawn that Fibonacci in play, okay, from the high to the low or the low to the high, then you've got to stick to it. So the only level that should be important is the 50% for me. If you're buying or selling into that, but then again, they're all important, because you might want to sell down to the 23.6, then to 38.2. It's down to you as the trader. All I'm saying is that if you draw a Fibonacci onto your chart, it has to be for a reason. And if the move is extended and strong enough, then these Fibonacci levels won't come into play. I mean, it's not It's not guesswork. It's not. I can show you in live charts. You know, at the end of the session, if you've got time, I'll just bring up a random chart and I'll show you Fibonacci. Okay. It isn't my study. Okay. But what I'm telling you is, if you draw it in the right kind of way, and you draw it from the low to the higher to the high to low of a particular extended aggressive move, then these particular percentages will come into play. And it's not just they may, they will. Okay? They absolutely will. You can't do anything else apart from that. So when you use Fibonacci retracements, these are the ones again that I like to use. Okay, so look at this chart here. Okay, I'm just going to bring the pointer on. We see an extended strong move. Okay, so we see the market a bit of a doji here. Then 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay, 9 green candles. So nothing can go in one direction infinitely, forever. It just can't. Markets don't work that way. People take profit. People take opposing views. So when this market then, reaches the top, you've got to think, all right, again, I know what you're going to say. Well, Steve, how do you pick the bottom? How do you pick the top? Well, the bottom is the first green candle. That's the easy part. The top is the difficult part. But realistically, when you see 5, 6, 7, 8, 9, 10 hourly candles all green, you know at some point it's going to have to retrace. So what we're looking for is that 80% of the time, that 80% edge. So the market, once it looks like it's running out of momentum, we see these 9 candles, then the one red candle, then we've hit the top. Okay, so we draw our Fibonacci from the low to the high, and we're aiming for that 50%. So it takes 9 hours to get there. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. It takes 15 candles. Okay, it's nearly double the amount of time to hit the 50%, but it does. But in the same respect, it doesn't make a significant higher high. So that's why you've drawn your Fibonacci in, because the market has not closed above this high that it's made here on the end of this bull run. And then when the Fibonacci comes into play, the market looks to come down, 38.2 becomes support resistance, 23.6, then 38.2, again another turning point, then the 50%, and once we close below that, the market retraces to 100%. Okay, so not saying it's an easy way to trade, but once you've picked the low to the high, you've got 30 trading candles or so in order to make your decisions. You can sell the 23.6, sell the 38.2, sell the 50%. Or you can, again, you can buy these levels. It doesn't make any difference. But once you know the relevance they have in the market of what's happened in the past, you can predict the future. So again, make your Fibonacci break into steps. So anything that moves in the markets has generally 2 or 3 steps in it. Think of the Elliott wave, a presentation I've done in the past. The Elliott wave has 5 full cycles, but anything that moves will move in waves. So the first one, 9 up candles, then we see the consolidation between the 0.0 and the 23.6. Then the market then finally breaks back down. It goes all the way down to the 100%. But the 50% is your target. So you might only sell the high and make it back to the 50. But that's still enough money to be made. You don't have to hold it to 100%. You can still make 20, 30, 40, 50, 100 ticks out of selling to 50% rather than, just waiting for the 100%. So again, it depends on the candles you use. These are 15-minute candles. The 9 15-minute candles, you have to wait 2.5 hours. If these hourly candles, you have to wait nearly a day. So it has to be relevant. So the other side is, if you're looking for these retracements to happen, then they have to be relevant in the same way. They won't just happen in the next second, the next minute. They'll take a proportion of amount of time. As a rule of thumb, if something goes up for 9 hours solid, it's going to take 9 hours to get down. As a basic rule of thumb. In this case, it's taking double the time. So again, you have to hold on to your trades in order to maximize your profits. Yes, Constantine, you can use 30-minute candles. I would say with Fibonacci, don't go any lower than 15-minute candles. So 15-minute, 30-minute, hourly candles, daily, weekly, monthly, are great for Fibonacci. Don't go any lower than 15 minutes. But yes, this works on 30 minutes just as well as any other time frame. So again, look at the hourly. So I'm taking this as hourly candles. Okay, so step 1, look, big candles. Big candles show volume, consistent higher highs. Okay, high of the move is on resistant levels. So every time this market's going up, it's finding support on the levels. Consolidation. You're always going to have some consolidation. There's no significant higher highs made, but more importantly, the price does not close above the high that's made. Okay, so the high that we've drawn the Fibonacci from, we don't make a high above it. Okay, so if we did and significantly closed above that, the Fibonacci wouldn't work. Then we see sideways movement, indicating the market is rethinking its opinion and consolidating. Therefore, the reversal or the new trend should continue. So once we identify the consolidation part, then we're looking for the retracement. Okay, so that's not the easy part, but this is the brave part. You see a lot of volatility. Okay, you're always going to see that because people are going to be buying and selling, getting in and getting out of positions, but you've got to hold true. So for me, there remains no higher highs or close above the 0.0. So 23 and 38.2 come into play, and the key 50% level are then tested. Once we close below that 50%, well, it's game over, isn't it? The market goes down and retraces 100%. So I wouldn't say the 23, 38 are irrelevant, but for me, they're targets. They're targets to be hit and broke. You're always looking for that 50%. And once you close below that 50%, then the likelihood is the 80% chance is the market retraces that 100% of the Fibonacci move. And again, likewise, if we close above the 50%, the market will move up, and generally 80% of the time will make a new high. You know, again, that's just how Fibonacci works. So the time zones is another way of viewing Fibonacci. And these are a series of vertical lines that use the Fibonacci numbers as intervals to show you of when these same kind of principles can happen. So Fib numbers are 1, 2, 3, 5, 8, 13, 21, 34, and they go on. As I said, you know, the Fibonacci numbers are they're not my creation. You know, there's something that happens, you know, in mathematics and been around for a long time. So for me, it's like anything. You know, we learn from the past to predict the future. So why wouldn't we look at historical things, you know, in not just history but in charting to predict what will happen in the future? So time zones really for me act very much like the Fibonacci retracement, but they're much more kind of much more visual, okay, and they don't really give you targets as the Fibonacci does. They more give you an indication of when these moves will happen. So you can see in this particular example here, we see the same movement, okay, the 9 green candles. Then 1 to 2 represents a consolidation period, 2 to 3 consolidation period coming to an end, and 3 to 5 the retracement. So if you think like this is the 23.6, 38, this is the 50%, and then the move happens. Okay, so time zones again, you just do from the low to the high, and this will draw out these Fibonacci lines that are spaced apart. And again, it's something else that can be used in your favor. I personally, as I said, don't use Fibonacci time zones, but it's not to say they're not relevant. So again, if you're using Fibonacci time zones, you know, try a daily chart. I mean, if you want to use the time zones for bigger potential moves, unlike the retracement pattern, then use them in this way. So again, all these candles are dailies. So we're talking about months worth of data here, you know, weeks and weeks of data. So 0 to 1 identifies the market's moving up. There's more green candles than are red. Then 1 to 3, it's consolidation. 5 to 8, the continuation. 13 is the period of retracement. So it really does depend how you want to use it. But for me, it's all about understanding this area here. The market wants to move up. And once you break through that, you're using the Fibonacci time zones to tell you that there'll be an area of consolidation and eventual retracement. Okay, but it's catching the right kind of timings of these things. Another one you could use is Fibonacci fans. So Fibonacci fans, again, trying to identify areas of support and resistance, but again, using the key elements of the 38.2, 50%, and 61.8. So all we do is draw a Fibonacci from the low here down to the low here, and that draws this fan. So you can see these Fibonacci lines act as resistance, act as support. Do I use these? I'll be honest, guys, I don't use Fibonacci fans, but it's a self-fulfilling prophecy. If Fibonacci fans work for somebody else, then they're going to work for the market. But realistically, I would draw Fibonacci fans on when you don't have any kind of real bias. If you don't have any kind of technical key levels of support or resistance. Draw some Fibonacci fans on to see if you can really gauge some idea what the market's trying to do. For me, I'd rather use Bollinger Bands and moving average rather than Fibonacci fans, but you can see it works quite well. The market again hits these tops, acts as resistance. The market hits these bottoms, acts as support. Okay. Well, you use the fans, Ramesh, in the same way. I mean, you use them as any Fibonacci. You draw it from a significant point, okay, to a significant point. So in this, the market's moving down. We can see that. So we do it from a significant low here to a significant low here. So you draw the line from here to here, okay, and that gives you these fans here. And as I say, they act as support, they act as resistance, quite well. The market dips down every time we hit these as resistance, okay, moving down, and then here the market uses them as support and moves up. So you just draw it from significant points, so from here to here. So again, there's no exact way of using Fibonacci. It's down to everyone's individual interpretation, but you have to think about using it in the best way possible, because Fibonacci works because of the self-fulfilling prophecy. So if you use Fibonacci like everyone else, it'll work. If you use Fibonacci in a weird and wonderful way nobody else does, then how can it work? Okay, so fibs are just a significant high to a significant low, or a significant low to a significant lower low, a significant high to a significant higher high. That's how you draw fibs. Fibonacci arcs, exactly the same way. This is just the same chart shown with Fibonacci arcs. So instead of drawing the fans, this is the arc. So it's Fibonacci is drawn from the low. Let me just draw it in from here to here, and that gives you these arcs. But I wouldn't draw the arcs in. All I'd do is I'd draw a straight line from here to here of support and resistance. That's how I'd use the fans. Why else would you use it? So basically, when we come above this line, that's support, resistance, 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 support, breaks it, support, resistance, breaks above it. That's how you'd use it. Again, it's very crudely drawn, but what you'd use the fans are for ultimate points of support and resistance. And again, that's just the same way as the fans, the retracement. It's just displayed in a slightly different visual way. It's the same principle. So again, this is how I would draw it personally, as support and resistance. So resistance, these arcs, but again, we close above it, resistance, support, 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 support. So that's how I would draw it. Rather than use the actual arcs themselves, I just draw straight lines, okay, and take away with the Fibonacci. So extensions are something different, okay? So extensions, it depends how you use them. Extensions are on the way down. So once you've done the low to the high, okay, then you've got these 161, 261, 423. They're the over extensions, okay? That's where the market can possibly go down to. You have extensions on the upside, which are the 100% and the 161, because it works on the other way as well. Again, that's really when you're trying to make new highs in the market when you have no levels, I would say. But the Fibonacci extensions, again, once you close below 50%, you're looking for that key 100% level. Once you broke below the 100% level, then you have these key levels, the 161, 261, and 423. Okay, so once the highs have been rejected and you broke below the 50%, then these are your targets down to here. Okay, and these levels, again, as I say, guys, they work time and time again. So overextension levels of 161, 261, and 423 are really important. So the key to using Fibonacci for me personally is going with the percentage, okay? Once you've made the highs on the lows, you've got a grasp on the market. Once a higher high has failed to be made or a lower low has been failed to be made, then you're kind of already there. The Fibonacci is almost inevitable. But once you understand how to draw Fibonacci in the right way, then you've got a fair chance of getting to them retracement levels. So again, I can't say any clearer that in my experience, 80% of the time, an overextended directional move will retrace to at least 50%. Okay, and I'll stand by that. I will stand by that on a fundamental move, on a technical move, on anything above an hourly chart. An overextended move will retrace to 50%, 80% of the time. Okay, I cannot give you more of an edge than that. Okay, so it makes it a very powerful tool, because once you understand the high and the low, then the rest of it is rudimentary for me. Okay. Okay, well, Schumer's just saying he's made money in the 50%. Well, that's what we want to hear. That's that's real testament to what we're trying to achieve here. The 50% is a very powerful, directional pull, and if other traders are using it, then we should. Okay, so again, it's using Fibonacci in the right time scales. It's making sure you pick the correct high and low, and the 50% is a target. But again, you can do anything. You can sell or buy into that target, or you can buy back at the 50%. You have to just use it in the right way that fits in with your trading strategy. For me, using Fibonacci isn't on its own. You have to use other supporting indicators and oscillators. Use your RSI, use Bollinger Bands, use key support and resistance. Fibonacci is not a tool just on its own. I use Fibonacci as a tool on its own when I'm trading fundamental data. So if we trade non-farm payrolls like I will do tomorrow, I will use maybe a Fibonacci in the first 5-minute candle, because that is real data. That's quick, fast-moving, interpretation of what's just happened. But in normal day-to-day trading, you have to take into account if the market's overbought, oversold, where the Bollinger Bands are, the moving average is. If we're overbought, oversold, all these different things will help you determine, if a Fibonacci is actually ready to be drawn. Because no point just doing a Fibonacci for the sake of it. Because unless it's an extended move, the Fibonacci principles won't come into play. So working example, look at the Bollinger Band. We broke above the upper Bollinger Band. RSI is at 82.8. Above 70 is generally considered as overbought. Fibonacci extensions, we have our targets. So the market hits 100%. Okay, we're looking for that 50% retracement. Okay, we close below the 50%, the market then moves down. Okay, so take into account things like your Fibonacci. Draw straight lines in. Above 30. Okay, below 30 is oversold. Above 70 is overbought. So draw that in your RSI and link it up. So once we hit this high level of 82.8, we know the market at some point has to retrace. Where's it going to get to? The 50%. Below that, the overextension levels. Simple as that, guys. Okay, any questions, any thoughts, guys? Anything you'd like to know? I mean, join me tomorrow for the live non-farm payrolls. I will always use Fibonacci on the initial spike of non-farm payrolls. And remember, I've traded 34 non-farm payrolls. I think I've only ever lost once, and I generally just use the Fibonacci principle. So, again, come and watch me do this in real live time. Any thoughts? Any questions? Well, like I said, guys, I mean, there's many educators out there, many trading educators out there, many people that say they've got the answers. We're very lucky. Intratrader pay me enough money, to kind of rock up and do these things for free, for you guys for free. I generally make money on non-farm payrolls, not because I'm the best trader in the world, just because I'm prepared. I understand the principles, I understand the data, and we trade accordingly. And that's all we can ask of ourselves as traders. Yeah, well, I'll tell you what I'll do. I'm going to trade some different pairs. So I'm going to look at the S&P, obviously. I'll look at gold, and I'll probably trade the euro dollar as well on the back of non-farm payroll. So a very interesting session it will be.